Adrian Lim of Aberdeen Asset Management joins us. It gives me great pleasure to connect with him at a time when everybody is trying to find a simple solution. Why have markets managed to climb the wall of worry? Adrian, good to have you back on ET now. Hope everything is safe. I understand from few friends in Singapore that Singapore life is back to normal. Well, you cannot go for a party at Clarke, but you can certainly walk to your office and enjoy a cup of coffee. So how is the situation like in the part of the world you are in right now?
Well, about a week and a half ago, a significant change to lift restrictions was made. So schools were the main difference, and students were allowed to go back in at about 50 to 60% capacity at that point in time. Life is certainly not back to normal. You can buy your coffee. It has to be takeaway. You cannot go into your office unless you're working in an essential service. And in fund management, you have the tools to work from home and the infrastructure to work from home. So out of our 250 heads in our Singapore office, I would say that only a handful, about a dozen or so, have the right of access into the office, but they don't practice that. Most of us, a significant number of us, are working from home. So it's not life back to normal. What we expect is another wave of restrictions to be lifted. If things go well, the regulators and the government officials will monitor this lifting of restrictions, and will then assess to see what the next layer of restrictions would be. But having said that, I think if you look at the statistics, although there have been severe testing allowed and severe infection rates, but actually fatality rates have been very low. So I think there's generally a sense of discipline and calm in society, but we really need to wait and see what happens next.
Well, good to hear that, Adrian, that things are improving on the margin. Okay, Adrian, markets, what's going on? Markets, they say, climbs a wall of worry, but in this case, emerging markets and developed markets have managed to climb a mile long of worry. The crisis, the condition of economy, the mess companies are in, it needs no introduction. Yet, Nasdaq is at an all-time high, and emerging markets are up anywhere between 30 to 50% from the recent lows. What explains this comeback by the bulls?
Well, I think the markets are just looking for good news. It is very much sentiment-driven at this point in time. I think in March, when you saw the collapse in markets, you saw the fact that it was universal, it was across asset classes, it was across geographic regions, it was in equities, it was in debt instruments as well. And now I think there's some exuberance as to the sense of relief, that has come through. Because broadly speaking, in most markets, at least in Asia, you're seeing various degrees of restrictions being lifted. I think that's sentiment-driven, and I think it's forward-looking and optimistic. But although I don't see the lows in March likely again, I don't think it's a smooth ride from here. There will be waves of disappointing results this year, and to some extent, investors will be looking towards 2021 numbers or 2022 numbers in a recovery. And the markets always look ahead. So that explains some of the optimism and some of that bounce. But you are right. There are lots of things to worry about. There's a lot of artificial liquidity to support or reduce the pain. Rightly so, because this is quite unprecedented in these times. But it's very difficult to call a universal recovery or a sustained rally from here.
Adrian, when you speak to your investors, what has been their experience of emerging markets? Frankly, if one looks at a market like India, a market which we represent, even though the potential was great, with the exception of few banks and consumer names, emerging markets have not really given very gratifying results if I compare them with what the Amazons and the Googles of the world have done. So what is your pitch now to your clients who want to invest with you but are seriously anxious about the underperformance in dollar currency which emerging markets have given?
Well, that's a complicated question. What happens is that if you compare to the likes of Google and Amazon and Facebook, you cannot take emerging markets as a fair comparison. You should have looked at the likes of Tencent and InfoEdge and Alibaba, for example. That would be a more similar comparison than just taking, the largest market cap companies that happen to be in technology in the US. So there are a few layers to that question right there. I would say that within the emerging markets, I would say that all geographic segments have been impacted, not just emerging markets. And the shakeout isn't complete yet. What we do need to see beyond this short-term anxiety and uncertainty is the prospects for sustained growth in these economies and markets over the medium term and long term. And I think what you do see is that the case for emerging markets remain strong. You get a very strong demographic. You've got the increasing levels of fiscal discipline in some markets. It's not universal. You do need to be selective, but there are signs of fiscal discipline over the last 10, 15 years that have developed. And you've got innovation and very dynamic consumers and spenders. So I think the case for emerging markets remain a strong one, but you can't just buy the asset class. You need to be quite selective in which business models you want to participate in and what valuations you want to participate in. And like you say, you can always find exceptions within the developed world as well, as in the case of Amazon and Google. So you do need to go in with your eyes open, but the underlying strength of the emerging market case remains a strong one, I think, over the long term.
One central theme, Adrian, for many years for Aberdeen Asset Management has been private banks. If I look at your last declared portfolio, whatever is there in the public domain, you still have a large exposure to Indian private banks. But given the recent concerns which have come on the economy, on the NPA front, on the moratorium front, do you think private banks are likely to become more like market performers and not outperformers? Do you worry about their exposure?
Yeah, there are things to worry about within the Indian banking and financial system. All the things that you mentioned, the rising stress on weaker balance sheets, on weaker credit, will be something that the banks will need to tackle and manage over the medium term. The moratorium is an effective tool for the short term, but the danger is that the banking system or the financial system relies too heavily on the moratorium and then neglects to sort out the difficult problems that it is faced with. So it's a good tool for the short term. It provides some relief, some stability, but you don't want to be used to those crutches at all. I think within that landscape, the private banks remain strong growth stories for us over the medium and long term. Good balance sheets, a very strong deposit franchise, and we hold the likes of, I wouldn't say all private banks are better than non-private banks, but we have confidence in the likes of Kotak and the likes of HDFC Bank, and we have quite a lot of those institutions.
Did you participate in any of the recent promoter blocks which came in the market, whether it's Bharti or Kotak Mahindra Bank or HDFC Life? Yeah, we have looked at some of those, and at the right price, we have participated. But it's not a uniform. It's not a uniform decision to buy in all these rights opportunities. It really depends on the price. It really depends on the business model. It's not. We don't look at
we are more likely to participate if it's a name that we already hold and it gives us a buying opportunity of a block that is sizable at a decent price. But you do need to be quite careful as well, because there is this is a window of financing for some of the stronger companies, and we do need to be mindful because there are still some potholes that need to be navigated, even with the rights issue in place. So I would caution against placing money uniformly across all rights issues that come your way.
But post the COVID crisis, let's say from March to June, which is about 3.5 months, little about 3.5 months, in Indian equities, have you been a net buyer or a net seller?
We have been net. I don't have the latest data for specifically those periods of time, but we have been trading quite actively. I would suspect we're net buyers. Our assets under management have been relatively stable as well. So we have been spending some time communicating with our client base on how the fundamentals within India remain intact. So that's given us the stability to trade. Our trading has come through 2-3 different teams. The first team would be to make sure that we buy in stocks that have strong balance sheets or capital structures that would allow them to ride or negotiate or manage through this uncertain 2-3 quarters that we think COVID will impact quite drastically. And then we look towards also shifting from stocks that have done well relatively into stocks that have not done quite so well, and also into opportunities that with the dip in March and April gave us certain windows to pick up a little bit more stock in the businesses that we like. So there's a lot of interesting price ranges and volatility that make us think about trading decisions, but it's not quite so easy to always execute because there is a lot of volatility in the market, and if you look at the volume and liquidity, it's not always there, even though price is at a certain level. So that makes the stock a lot more volatile because any incremental demand or supply can shift the price disproportionately. So we need to be quite disciplined in the price levels that we trade stocks in during this period of time.
Adrian, so if I have to, let's say, divide the world in two, historians, they divide the world into BC and AD. Let's divide the world into pre-COVID and post-COVID. The world has changed. Some are using the term new normal. Some are using the word, crisis. Some are using the word panic. So what have been the changes which are permanent in your post-COVID portfolio from your pre-COVID portfolio? If the lay of the land and if the world has changed, I'm sure the way you are investing also would have changed.
What we try and do is during this crisis, we have seen COVID doesn't affect all sectors equally. There are 2-3 sectors which are far more resilient. Although if you look at the recent share prices, they may not demonstrate that because the market hasn't priced that in yet. And there are 3-4 sectors that have been hit disproportionately hard by COVID. The airlines, for example, struggle. Consumer, retail or dining or tourism or leisure activities struggle. These are obvious. How much of this is structural, it's very difficult to say. And then when you look at the more resilient business models, a hard shift towards online consumption or a more permanent shift towards online consumption seems to be a beneficiary. So this would benefit stocks that are in that space. You also see a resilience in telecommunications and essential services. Some of that come in the form of drugs or hospital services, and some of that come in the form of consumer staples. The interesting thing for me is that I think what COVID has done is it has accelerated a few number of themes that have existed even pre-COVID. The shift towards online consumption, for example, or towards delivery, for example, have been things that look like they have been catalyzed by the COVID situation. The other things, I think the uncertainty and the anxiety and the way we've gone about living and working over the last 2 months have been very different from the past. But I am not so sure in 12 months' time you would see some of these changes still in place. So I do expect that quite a lot of things that we see now in the short term that have been dramatic will be rolled back again. There will be post-COVID world in 2 years' time will not be substantially different from pre-COVID world in my view. And from a portfolio perspective, I think we do need to be mindful of overreacting to naysayers in saying that this industry will totally disappear or that industry will totally disappear. Changes will take time, will take place, will take time, but we need to make sure we don't overreact to some of these things. So what's really important for us is to keep in touch with the companies that we invest in and to make clear calls about where we think the value and the quality of these stocks are. Some of the themes are not investable at all. So you might say that consumer behavior will change in a certain way, but then you look at the stock markets and some of these themes do not have stocks that are proxy towards some of these structural changes, at least not yet. So that's something that we need to be mindful of as well.
Adrian, you've owned consumer stocks in the past, whether it is food companies or names like HUL. What is your view there? Would you be happy to own consumer stocks for next 4 or 5 years in your India exposure?
Yeah, why not? What would be different? Some of these consumer companies are providing the essential services and essential products that people need. The delivery systems and their distribution systems may evolve, but some of these companies have some of the best, management talent in distribution systems and are at the forefront of this structural change. It may not be obvious yet because they are not, they're not flagged as internet companies, but some of the most innovative online migrations have been done by the likes of some of these FMCG players.
Adrian, where does insurance fit in? When we spoke last, you were excited about owning insurance companies. In the post-COVID world, I would imagine the need to buy insurance, the need to buy financial instruments which protect your family both on the health front, on the life front will only increase. Are you excited to own anything in the insurance space, and what do you own if you at all have exposure to the insurance sector in India?
We have exposure to 3 entities directly and indirectly. We like SBI Life. We have exposure through some of Max. And then we have some exposure through our holdings in HDFC, which also have HDFC Standard Life as an interest. So we do like the insurance story, but like I say, the education of the consumer in India on the importance of insurance has been in place for some time, just like the online migration to different delivery platforms. Does COVID impact that? Yes. Does it accelerate it? Yes. Does it make some of these structural changes more permanent or behavioral positions more permanent? Yes. But would these things have happened anyway without COVID? Yes, they would have. So likewise, it's important to take a moderate view of things. And we like the insurance space, but we have always liked that space for some time, and it's not COVID driven at all. We like the fundamentals in that sector. We've been watching it for a long time, and we think that over the last 4 or 5 years, that sector is a lot better organized, is a lot more professional. The shift towards protecting consumer interests have been very strong, and we think the regulators have done a good job there. So those things drive our interest in insurance far more than just COVID.
Adrian, before the interview started, I was counting the number of years I've interacted with you, and guess what? The number stands at about 15 years now. And in the last 15 years, there have been some stocks which have been constant in your portfolio. And one of them is HDFC Life, and the other are large cap IT companies. So for next 5 years also, can I safely assume that what Adrian Lim liked 10 years ago, he will continue to like it for next 5 years, which is a combination of private banks and IT and names like HDFC Limited?
Well, there's always a danger of extrapolating, and I'm also very mindful of my biases as well. I think they've done very well for us over the long term, but you can never really assume. I think that if you look at the last 15 years, the times we've been interacting, some of the best management teams are from these sectors, and they are a good benchmark for other management teams to hold themselves to. But things change. It's very difficult. 5 years is quite some time, and the next 15 years is quite a long time. So I think as long as they maintain the pursuit of doing the best for their customers at the right price point, the chances are that they will be useful for our portfolio. But complacency is quite a tricky thing to manage as well. And you can go back in history over 50 years and 30 years, and there are many things in the Fortune 500, many companies in the Fortune 500 that no longer exist. So we need to be always mindful of that.
Oh, that's a great point. Never say never. That's the way investing world moves. Never suffer with recency bias. Don't have complacency. That's how good investors always think and speak. So Adrian, what would be the outside theme for you as a fund manager, for Aberdeen as a AMC for next 5 years, where you think there is scope for earnings, and where do you think there is a scope for P multiple? Because that's how you make money, when you get the earnings cycle right and when you get the P expansion right. What would be that next 3 to 5 year outside theme according to you, based on earnings, growth, fundamentals, and Indian economy's dynamics?
I think that over the next 5 years, it's difficult to see, for example, the exact pace. But over the next 5 years, I would expect India to repair its financial structural challenges within the financial markets. I would like to see a sustained level of economic growth, which means that the credit demand would be at a sustained, healthy level, and that's why we like the opportunities we see in banking and in financial services, whether that's the form of life insurance or that's the form of commercial credit within India. So that's something that we think is very attractive over long term. In the supplementary story to that would be in areas of services that look interesting. whether that's in IT or whether that's in some of the consumer products, that's something that could be interesting as well. But you do need to be a lot more selective. So we expect the consumer demand to drive consumption in staples and discretionary items, and where structurally the level of competition is healthy, we would have net positive exposure to those sectors. So the consumer story as well as the financial services story is where we think India would outperform over the next 5 years.
Okay, Adrian, closing comments. You've run a portfolio where the India positioning has been either overweight or marginally above what the MSCI benchmarks are. For next 3 years, does it make sense to run a portfolio which is overweight on India or underweight on India? Because you are in the business of allocating capital. So would you allocate higher than greater capital to India, or capital which is lower than the normal averages you've run for next 3 years?
Well, we currently run an overweight to India. It's not as high as it used to be. I mean, if you look at the highest that we have had an overweight position over the last 15 years, this would not be it, but it's still a significant overweight position. It is very much dependent on the stocks we see. If you're looking for a macro call, I'm not the person to go to. But we do see that when you compare the stock universe in India and you pick out the best companies there and you weigh it from the quality of management, the business case, the competitive dynamics, the balance sheet and the cash flows, we still see superior stock opportunities in India, and that's what's driving the overweight. But it's 3 years, 5 years is a long time. There could be huge exuberance in the Indian market, in spite of what you currently feel. Relative to valuations in the region, if India was trading at 50, 60% premium to that, we could be trimming that down to a neutral weight. So we do have to be quite nimble. But the underlying companies in India continue to give us good opportunities for us to participate in.
Well, Adrian, fantastic to have you back. Stay safe, my friend. And I really appreciate your time that you were able to find time in the middle of your busy schedule.
Thank you.